All right, everybody. Hope you all are doing well this evening. Welcome to the Note Nation Top 40 Tour as we roll into, I guess you could say, what's supposed to be the happiest place on earth, Orlando, Florida, ladies and gentlemen. Honored to have you guys join us tonight. We roll into the final week of the Note Nation Top 40 Tour and really focusing on a city that's kind of like our second home here. We spend a lot of time out in Orlando, especially Florida, and definitely spend a lot of time. But once again, guys and gals, welcome to the Note Nation Top 40 Tour. We've got a variety of local and national investors join us tonight to see as we talk about the Orlando. You can always check out the full schedule and all the replays of the other cities that we're doing on our Note Nation Top 40 Tour by going to notenationtop40.com. We'll be discussing the statistics and the numbers facing Orlando right now with everything that's going on in the craziness of the world. We'll also discuss about future opportunities, where to look for those deals in Orlando, and how to get started. So if you guys don't know who I am, I'm Scott Carson. Honored to be here with you guys tonight. Honored that you join an hour out of your busy, hectic Tuesday night or Wednesday night, whenever you're watching this, guys. I've been an active real estate investor since 2002, CEO of WeCloseNotes.com. That's our main website where you can find out more information about what we do and our different educational and trainings and stuff like that for you guys too. So over the last 10 plus years, I've purchased over $500 million in debt for our own portfolio. I've been working and teaching with real estate investors since 2004. I'm the host of the popular nationally syndicated radio and podcast, the Note Closers show that you can listen to anywhere that you listen to podcasts. But I invest all across the country. Austin, Texas is home. And I'll tell you this, Florida, as I will joke about God's waiting room, but Florida for me has been actually the number one invested market for what I'm doing over the last 12 years. I bought more real estate than Florida than any other state. I bought more debt in the Sunshine State than any place else. So I think you guys are going to enjoy what we're going to talk about tonight for you. But our mission has always been at WeCloseNotes.com to help investors to accomplish their goals and dreams and increase their wealth through debt investing. Why am I taking time to focus on 40 cities? Well, because there's a lot of different things going on in the market right now. And there's also a lot of falsehoods, I believe. There's a lot of people, the market's great. It keeps going up and up and up. And I believe that's incorrect. So first and foremost, I'm doing this because I love to help investors. I love working with people to help solve problems. I was once a distressed borrower as well. We'll get to that in a second. But I do believe with what's going on in the market, just like it was 12 years ago, I believe this is an opportunity for a lot of people, a lot of investors to not only make a tremendous amount of wealth, but to help a lot of people struggling out there right now. As I mentioned before, I was once a distressed borrower, so I empathize with those that are facing evictions, out of work, facing foreclosures. There's a lot of them specifically in Florida out there compared to other places. And guys and gals, there is nothing greater than helping someone overcome an obstacle or achieve a goal or dream that they once thought was impossible. For many homeowners, the dream of home ownership is awesome. It really sucks and turns into a nightmare when you can't afford your payments and you're facing foreclosure, facing evictions with everything that's going on, when things happen outside of your control. So I'm a big believer in helping people, and I really want to help 1,000 real estate investors in the next 12 months tap into what's going on in the market and the opportunities that are available to all of us if you're willing to take action and get rock and roll. And I get asked this question every day. Where are the opportunities, Scott, at? Where are they at? Because I don't seem to think that there's any in my market. And I'm going to tell you right now, ladies and gentlemen, there are opportunities everywhere. Everywhere out there, no matter what type of asset class you're looking at, whether you're looking at self-storage, apartments, single-family homes, mobile home parks, or affordable housing, office buildings, or even hotels, motels have been hit very hard out there. There are opportunities everywhere. And the beautiful thing about this opportunity, it doesn't matter what your credit score is. It doesn't matter how much money you have in the bank. It doesn't matter on how old you are, what color skin you are, what sex you are. There is an opportunity out here. And I don't care if you've been a business owner in the past that has failed or succeeded or looking for new opportunities right now. Don't care if you're facing a forbearance agreement right now or you're behind your mortgage. There are opportunities if you're willing to take action and be coachable with what's going on in the market. It is not that difficult to tap into what we're going to be talking about tonight. And a lot of people know about this, but most people don't understand it. Most people just don't see the opportunities because they've been talked over. Other people out there make you think that, you can't tap into this. And every one of us can tap into what we're talking about tonight. And we all have different goals and dreams that we want to accomplish. And whatever your goal is, it's great to have a goal. It's something that has to be kind of your North Star. your compass point to go to. Maybe it's to retire on the beach more, drinking margaritas and pina coladas after working so hard. Maybe it's to spend more time with your spouse. Maybe it's to put your kids through school, whether it's online or in person. Maybe it's to say, hey, mom, hey, dad, I got you. You've worked hard, and I know you don't have enough. Like most people are in retirement age, don't have enough saved. Maybe you want to travel more. God knows I'm tired of a staycation and want to go on a very fun vacation and get the heck out of Dodge. Maybe it's just to upgrade your crib, your house, your toys, to take an opportunity of what's going on in the market. Whatever your goal is, we all know one thing. It is achievable. But secondly, it all takes capital. It all takes money for us all to do that. And a lot of us out there like, I can't buy this with what I have in my account unless I can write a check and let it bounce, okay? I don't want to do that. And what's going on right now in the market, you don't need to have your own capital. You don't need to have your own credit to do this. We'll discuss what's going on right now. But anyway, let's dive right into the numbers. What do the national numbers say about what's going on out there? It is not quite a rosy picture like some people will say. Currently 11.1% unemployment rate as of June. That number dipped a little bit, which is good. It increased to decreased to 10.2% in July. That's a good sign in the right direction, okay? That's national. There's basically 50 million people that have filed for unemployment that are waiting on it. They're waiting on the government to bail out. There's a lot of people that are still struggling out there across the country. They expect over 52% of small businesses are expected to fail or not return, especially with minority-owned businesses being where they think 75% of minority-owned businesses aren't going to rebound or come back. 10% of homeowners, though, guys and gals, were already struggling to stay current prior to February. That's right. 10% of Americans were already struggling to stay current. And the numbers don't lie there when you see that the most recent national mortgage delinquency rate came out was 8.22%. That's almost a full, about a half a point higher than it was for June. That's right, it was 7.66. It has now increased to 8.22. So about basically 1 out of every 12 borrowers is at least 90 days or greater behind on their mortgage, not just a month late, 30 days or longer behind. That's not a good thing to have. Currently, that number represents 4.2 million Americans currently in default. 4.2 million homeowners currently in default. And I have to say this, Florida has a big chunk of that. Florida has a tremendous amount of chunk of that compared to other places out there, all right? Now, if you look at the numbers and look at history, it took us 18 months from when everything started back during the Great Recession from 2008. It took us 18 months to hit 1.6 million defaults at that time frame, okay? We're 2.5 times that in 2/3 faster time, in a third of the time it took. So here's what I'm trying to get. The rosy number, oh yeah, real estate keeps doing well. It's going to be great. That might be great in some price points, but it's not for a lot of people out there, okay? Now, if you look at what's going on in Florida on the Housing Hardship Index, this is something put on by Bankrate that takes a look at the unemployment and the default rates and kind of ranks every state on a state-by-state basis. Now, Florida, if you look at the map there in the dark blue, is one of the heavier hit states when it comes to, or one of the housing hardship states. Sorry, I shouldn't say Utah. I should say Florida. I just forgot to change it. The current unemployment rate, based on this, is 11.3% across the board. So Florida has a higher unemployment rate than the rest of the country. You look at the delinquency rate, 9.63%. That's the delinquency rate on the mortgages, not a month behind, 90 days or later. That point, it's higher than the national average. That puts Florida ranked in the top 15, number 14th nationally, okay? That's not good. You don't want to be in the top 10, top 14, top 15, really for the most part, because things are getting bad. Now, obviously, Florida's been hampered, obviously, because of tourism, hotels, retail, amusement parks. The cruise industry is a big thing there, not being able to travel to the parks. We all know the story, what's going on, all right? But let's look at the unemployment rates here. So Florida's numbers here, like it went down in June to 10.3, and then it bumped back up to 11.3, which is the opposite direction you want to be going in. You want that number going down to where it was something, hopefully, before all this happened in February at 2.8. And you see it spiked out at 13.8% unemployment rate for all of Florida in April. Now, looking at Orlando, the July's numbers are not out specifically for Orlando, But you can see that it spiked at 21.1% in May. Part of that, obviously, due to a lot of the theme parks laying off. June, it dropped to 16.5. Obviously, with some of the amusement parks opening back up, some of the hotels starting to open back up, we expect that number to be down a little bit, but probably still going to stay probably closer to 15%, which is very high compared to the rest of the country. Now, if you look at how the Orlando area is compared to the other counties, you see 11.2. Orlando is at 16.5. Lake County to the north is at 14.3. Orange County 17.2. Osceola County at 22.9% unemployment rate. Wow. Seminole County 10.3%. Yeah, we all know why that is, right? Everybody, the theme parks being out of business. Now, when you look at Disney furloughing 100,000 theme park employees, and then 70,000 of them have been laid off, all right? They're not back to normal. We've got friends that work for the parks who are still on furlough. They're expecting for another 6 months furlough through the end of the year, okay? Then you look at Universal Studios, roughly about 25,000 employees. They have not disclosed how many they've laid off. You look at SeaWorld laying off a bunch of employees, Legoland, all those things, and then even the hotels laying off, the biggest chain of hotels in the country laying off a ton of people. There's no reason why people are unemployed. People aren't showing up in their line of work. That leads to restaurants being closed. That leads to bars. All that stuff is auxiliary, environments around everything. Really, it's a house of cards that kind of falls in. And already Orlando is one of those areas where the average dollar rate of survival needs to be roughly about $20 an hour to stay above the poverty line. Most of the people working in these jobs aren't making $20 an hour. They're making less than $20 an hour. Now, if you compare Orlando to the rest of some of the major Florida cities and the areas, we kind of broke it up in a couple of places. So Orlando at 16.5%, Tampa just down I-4 is at 9.2%, Miami 11.3% unemployment rate, Jacksonville was surprisingly at 8%, Pensacola 7.4%, and then down by Naples is the 9.7 range, Southwest Florida part there. So you can see Orlando really is being hit hardest in Florida when it comes to the unemployment side. Now, looking at the obviously next results of that is the foreclosures. If people aren't paying their mortgage, they're being evicted, obviously, or they're failing to pay. Now, if you look at the biggest price point hit when it comes to foreclosures, it's in that $200,000 to $300,000 range or less. Really, I don't know why 300, 400 on there twice, but 300 and below for the most part is where the majority of your stuff is going to be hit as large. Now, the less than 100,000 homes, what's that? That's a lot of your condos that aren't being hit hard yet for the most part, okay? Now, foreclosures, one in every basically 7,900 homes in Orlando. That's not too bad, but when you look at the hardest hit zip codes, one in every 3,700 and 32833, one for every 4,200 and 32814. For some reason, the map didn't pull over there for you guys. You can see that month over month, auctions were up over the previous month a little bit, but down 95% compared to they were a year ago. Same thing, bank owns were up prior month, down the previous year. That's because some of the foreclosures already started to trickle in here. Okay, when you see the numbers drop like this, the filings, because you can't foreclose, you still have that moratorium on foreclosures that goes through the end of this month in just a few days, the end of August. Now, looking at, you can see it's really just dropped off. A little bit of a tick up in July versus June. Those are going to be more your investor style loans or people that were already delinquent prior to COVID kicking in. With the county starting to open up and the judges and the courts starting to open up a little bit, you've seen a few filings where people were already way behind on their mortgage prior to all this taking place. Now, Florida is one of those things that has current statewide moratoriums for foreclosures and evictions. That's still the case. It's been extended to September 1st, which is basically next Monday. But the thing there's a lot of call for DeSantis to go ahead and extend this a little bit because it's going to be ugly, okay? They're expecting a tsunami of evictions, and Florida alone has 800,000 renters, basically, that they expect to be in distress, all right? They have no real federal or state help after September 1st. They're expecting to see a huge amount of evictions taking place and then also foreclosures falling behind that. Now, Obviously, executive orders are always nice. This delays things through the 31st for your government-backed loans, your FHA loans, your government insured. If you're a tenant in a place that is in a government-backed loan, your extension is till August 31st anyway. Since DeSantis, one more day longer, September 1st. Florida is basically at 0% when it comes to foreclosures activity. This was through July. We don't have exact numbers yet for all of July and August. But things are starting to get back to normal here in a very interesting way, and it's not going to be in a good way when you look at everything that's going on in Orlando. Obviously, we're forecasting a huge wave of foreclosures, unprecedented job loss, mortgage payments. When you have a lot of people that are relying on these, I hate to say it, but minimum hourly jobs, because these big companies can just basically recycle people through minimum wage to fill a spot. Hey, it makes for a bad thing. I think Orlando is going to be ground zero for a lot of this whole new debacle of things going on. Now, if you look at the types of loans in default out there, it's a variety of products. But the most outstanding one that's basically been the worst numbers is your FHA loans. That's your first-time home buyers. That's your 200,000 or less homes. That's people that, hey, can have 3.5% down payment, not really credit-based for this so much, but what's affected them, though, has been the banks, honestly, donating that 3.5% down payment and paying up to 10 grand in closing costs. Bank of America has gotten rich for the last 24 months with a very similar product, especially the last 12 months, donating basically everything to get them in. And now the numbers came out for July. The numbers, when you compare it to that, it's basically 3 times worse for FHA foreclosures and defaults versus a traditional conventional mortgage. And then you see the numbers skyrocket in July from 9.69 to 15.6%. That's a 60% increase, ladies and gentlemen. That's people that, A, got into a house, now they can't pay for it. This is the dream of homeownership becoming a nightmare very quickly within a 6-month period. All right. Now we know that there's a ton of forbearances, and as the forbearance numbers continue to kind of shrink a little bit from when they peaked at basically just under 5 million homeowners, they still estimate there's somewhere around 4.2 million people in forbearance. They say there's probably an estimate around another 4 million borrowers out there across the country who should do a forbearance who have not reached out to their banker lenders. They've been playing it coy, not wanting to do anything. So what does this all mean? Am I being the Debbie Downer for tonight? I'm trying not to be, because there's opportunities in every market. Now, there are opportunities to help a lot of people, but honestly, if you're the consumer, it's bad news. If you're an investor like me, it can be good news for both parties if you know how to react on it. Obviously, Florida's higher defaults than the national average, longer foreclosure timeframes. For an FHA foreclosure to go through, it takes 810 days to foreclose on an FHA foreclosure. Now, normal foreclosure in Florida at about 9 months, but an FHA government-backed loan is going to take you roughly about 800 days to foreclose. So what does that mean? When you add in the backlog of forbearance agreements, the fact that the government has had 6 months to evaluate their portfolio, and here's the things, ladies and gentlemen, I can guarantee you those government-backed mortgages with FHA, Fannie, Freddie, they're not going to start the foreclosure process. They're going to go ahead and kick the can down the road another 6 months. They've already planned this on the front end 5 months ago. I was on a conference call that talked about that. So when you add in the backlog of forbearance agreements, the long time to foreclose, it is going to be a while, ladies and gentlemen, if you're a real estate investor in the Orlando market or Florida itself, before you ever see an REO, a real estate owned, or a foreclosure on the mass majority of stuff that's in default right now. Now, a lot of people are in default. It's just that the banks are delaying things, trying to hold things together a little bit. Now, what does this mean for commercial debt? We talked about the residential. The commercial debt is not government backed. It's not getting the bailouts that we see. We've seen for sale signs or more boarded up buildings. We've seen businesses out of business. All sorts of asset classes are closing. Half the businesses are expected to close. And that's what you have, especially going through the summer months. A lot of businesses in Central Florida revolve around tourism, revolve around people showing up and taking their summer vacations, all right? And that's not a good thing right now. I mean, commercial real estate in Florida, specifically Orlando, is taking a nosedive in a variety of places. Now, this is the most recent quarterly default rate when it comes across different types of commercial loans. You can see lodging, 27%. That number is higher In Orlando, almost double that is in default. Okay, take these numbers and run across the board, just about double, just for the Orlando market. Retail's always been on life support, struggling. They're expecting 50% of all the malls across the country not to recover, and that's the same thing for several malls there in Florida. Retail's been struck. Restaurants definitely are struggling. Not a good time. Now, if you look at what's kind of going on with Florida, when you look at the big 15 markets, now this commercial mortgage-backed security market, which is different than the bank market, took the biggest hit of $50 billion lost basically overnight in early March. Okay, now looking how it spreads out across the bigger states, you look at Miami. Miami's got $800 million in CMBS mortgages, commercial mortgage-backed securities, that's in default, okay, in delinquent balance, okay? North of Orlando, you have Atlanta, 690. Orlando's just under that number when it comes to CMBS size, but it's just not the CMBS stuff. It's the traditional banks that are also struggling. When you look at some of the default numbers out there across the country, 1 in 4 hotel loans are in default, 1 in 5 retail loans are in default. They expect that number to increase to 1 in 4. Hotels, 1 in 3. Expect a vacancy factor of at least 15% nationwide in retail and restaurant space, and that number to really probably be double in Orlando, 30% vacancy rates. Office vacancy is going to be set to increase roughly to 20% nationwide. Orlando, downtown Orlando, has been hit hard as well with office space, okay? You're going to see rents are expecting to fall 10 to 15% by year end on a national average, and continue to fall another 5 to 10% into 2021. Now, what does that mean when you look at stuff? Now, looking at Orlando, here's the thing about Orlando. Third largest exposure when it comes to hotels out there, okay? And in the next 6 months, there's an estimated somewhere around $660 million in loans coming due in the next 6 months, collateralized by 45 hotels alone. Just that number alone, okay? Okay? Probability, if things open up, is that, okay, they could get refinanced from 6% up to 74% if things work out. But the longer this thing goes on, the longer things stay shut down, it's not a good sign for Orlando. Now, what does that mean for us? Well, a lot of commercial real estate investors are looking, this is an opportunity. They're not going to waste time going after the big boys because the banks, the big guys, unlike 12 years ago, where a lot of Wall Street financed most of the distressed stuff, this time around, local banks have financed a lot of it. 12 years ago, CMBS companies financed about 64%. 2 out of every 3 loans was financed by CMBS guys. This time around, the last 2 years, when you look at the distressed stuff, roughly 53% of the distressed stuff has been financed by banks. Now, they're not financing it 90% or 95% like they would do in residential. It's different on the commercial side if you're not aware of this. A lot of times, banks will only finance roughly somewhere between 63 and 70% of value. Now, remember, your commercial mortgages are not based just on value, okay, or comps. They're based on cap rates, your rents, okay, vacancy factors, all that stuff goes in. So when you have increased vacancy factors, decreased rents coming in, that drives the value down of your commercial real estate. Well, banks don't want to be above 70% or 65%, but if the value goes down, their LTVs skyrocket, goes well beyond their comfort levels. So what does that mean? Well, that means the banks have had some time. They're going to give the borrowers time to try to get back on their feet a little bit. But at some point, if these things don't work out and people don't go back to work and businesses don't open back up, the bank's going to go back to the borrower and say, listen, I need you to bring 5, 10, 20% in cash to write down these loans. Otherwise, we're going to have to start foreclosure. They've given a pretend and extend for 6 months. They're allowing people to stay, businesses to try to operate best they can. The last thing you want to do is take back the real estate. But at some point, the piper's got to get paid, ladies and gentlemen. Now, where does that mean for an opportunity for investors like us? Hey, bring some capital, raise some money from investors, and go in and buy some of these loans, buy some of the debt, work with the current borrowers to try to keep them in place, or take the property back and try to reposition the property in different fashions. Now, we'll get to repositioning the properties in a second here. Now, the banks out there, when you think about that, they finance 53% of distressed debt. That's a big tab. In July, they expected the banks roughly to lose $48 billion in commercial real estate loans, the big banks. No offense, I think that's a far cry from what the final number is going to be. When you look at that, Bank of America just a few weeks ago set aside a record amount of money in reserves because they're believing they're going to lose it somewhere around 5.1 billion on the front side in the first quarter on these bad loans. That's a drop in the bucket. When you add in the other three big banks, besides Bank of America, Chase, Citi, Wells Fargo, it's bad. All right. Those four banks have reported at least 151 billion in loans with payments in deferral at mid-year. Okay, they've deferred a lot of stuff. Okay, let alone, here's the thing: in the second quarter, those four banks set aside 32 billion combined for loan losses in the second quarter. That's close to record. That's not what kind of record you want to set. Okay, when you look at the fact that all of them have billions of dollars, Wells Fargo, 12% of their primary, the first lien mortgage business is in deferrals. 10% of the second liens is in trouble. Okay, Wells Fargo, 44.2 billion of consumer loans in deferral. Citigroup, 20 billion. Bank of America figures they've set was deferring payments of 7.7 billion in commercial loans and 28.5 in consumer and small business debt. It's going to get a whole lot worse, and nobody's talking about this. The news wants you to worry about the numbers of people passing away. They're not focused on what's coming down the road. Oh, yeah, real estate's great, 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 great. Buy, buy, buy. I'm like, no, do not keep looking at the rearview mirror. Look at the future. That's the problem with most real estate agents. Oh, we're just going to go off last quarter's numbers and forget what we see going on around us. That is having a blind eye to what's really the bigger picture here, everybody. So where are the opportunities? Where are the ways to make money when it comes to what's going on out there? Is it going to be buying foreclosures and REOs? And I hate to say, ladies and gentlemen, no. Unless you want to wait around 2 years, 3 years for that to hit, it's just going to take a while. Don't run out and get your real estate license and say, I'm going to be an REO agent. Well, guess what? No, you're not. Okay? No, you're not. Is it going to be in the fix and flip business? No, it's not, because mezzanine lenders, hard money lenders are pulling back their financing. Their lending programs have dried up for the most part. It's not saying you can't go get a low interest rate on a primary residence. Of course, if you want to do that, hey, now would be a great time to buy a new primary residence because you could probably pick up something at a decent price. But as an investor, that's not really your best use of funds. Would it be in the rental market? Heck no. When you look at the amount of people that are going to be evicted, they're going to be facing the evictions, I would not want to be in the rental market right now. Now, where the biggest opportunity lies is not in owning the property, but in buying that debt. Now, Scott, you just told us that all these banks, all of this debt that's in deferral. That's correct. They've got an oversupply of debt in their books that they got to get off their books. They got to get something for that. That's where the real opportunities lie, in buying that distressed debt at huge discounts that is backed by real estate, residential or commercial, and then doing a variety of different exit strategies. Now, you're going to already starting to see some residential notes, primarily non-owner occupied investment hard money loans hitting the markets right now. But you're going to see the first big wave of the debt hitting the market in the fourth quarter. Why? Because the banks have had 6 months. They've had 6 months to decide who's naughty or who's nice. They're going to keep the nices, and the naughties that haven't been paying or in forbearance, they're going to look to move that off their books to somebody before year end. It always is the case in the fourth quarter. Let's get it all off their books. It's like hot potato, okay? Let's get it off our books before we have to take it down and start to really get it off and let somebody else deal with that, okay? Now, the commercial side, we're already seeing commercial debt hitting the books coming across our desk this quarter. A lot of my Wall Street guys have talked about the fact that they've seen more deals in the last 24 to 36 months in the last 2 to 3 months more than they've seen in the last 24 to 36 months, okay? A lot of opportunities out there if you know what to do. Now, the biggest opportunity isn't this big $5 million, $10 million, $50 million properties. It's actually that smaller balance stuff that's choking up the bank's arteries, ladies and gentlemen. Your local banks like to finance that small balance commercial, that sub $5 million. And really that $2.5 million value in commercial real estate is where the opportunity lies to come and buy it at a substantial discount and then work to be flexible with your tenants and the borrowers, trying to keep them in place, trying to help them recover in some sort of fashion. And we talked about being able to pivot. It might be buying a note on a hotel and working with the tenant to turn it from a hotel into an apartment complex. An investor did this in Arlington, Illinois. Took a brand new hotel and converted it into apartments because instead of being vacant and nobody showing up, there's still a need for affordable housing or apartments of the neck of the woods. Our buddy Garrison Gilbert, who's a student of ours, is doing this in Pennsylvania. He's doing this in Maryland, looking for that small balance hotel. that sub big chain, that mom and pop owner franchise who does not have the reserves, who has to shut down. And literally lots of hotels across the country had to shut down for 2 months and 3 months. You look at the biggest hotel chain in Orlando having to close its doors, lay off 75% of its staff. Okay. Now, maybe what else is there? Well, obviously Orlando has a lot of office space. We had an investor in Denver take this 110 unit office space and convert it from office to self-storage. Brilliant. Need a big need of self-storage. As people are downsizing, moving out of their offices, they need a place to store their office stuff. Why not have them store it with you? And I thought that was a brilliant play out there. Okay. Now, if you look at the banks in trouble, there are a bunch in Florida. We like to look at a list called the Bauer Financial. And now Bauer Financial basically is a bank rating system that evaluates banks and credit unions and sees what they file on a quarterly basis. If you look at, literally thousands of banks across the country. There's thousands of banks that lend or have offices or branches in Florida. But when you break down the list by banks that have at least 5 branches or more, that reduces the list to 1,578 banks. And if you take a look at whose main office is just in Florida as a snapshot, there are 38 banks that basically call Florida their primary home. Okay? 38 major banks with 5 branches or more. Now, if you look at those 38 banks, they have a combined $4.2 billion in 90 plus defaults, and an additional, this is as of June, and an additional $1.26 billion in loans that are 30 to 89 days late. That some of those have already transitioned now into that 90-day late, or are on the verge of about doing so. When this new quarter ends next month, boom, basically $5.5 billion distressed debt across those 38, if not worse. Now, out of that number, a big chunk of it, surprise, I found this surprisingly, is almost $4 billion of it is in non-performing single-family homes that are at least 90 days default. This is why I say I believe that Florida, specifically Orlando, is going to be ground zero, like Michigan was years ago with a great recession. Surprisingly, when we've run this for other cities and looked at other states, it's been a flip. 75% commercial loans, 25% residential. Completely the opposite switch. It's literally 80%, actually 85. No, actually that would be more so 90%. Okay. 90% in residential and only 10% in commercial. I think that the commercial numbers are going to be an even bigger number here later. If you look at the 2 biggest banks, TIAA, FSB has 94% of their portfolio is 90 days in default. Florida Capital Bank, which is only ranked a 2-star out of 5 stars, has 18% of their portfolio in default combined across the board. So we could go on and on, but that's just those 38. What about the other banks that lend in Florida that don't call Florida home? Yeah, that's an even bigger number. That's what I'm trying to say. There can be a lot of opportunity to come and buy this debt cheap, work out forbearance, modifications with the borrowers, something to keep them in the property. You just have to be able to do that and know where to go for that stuff. So why would you want to buy this distressed debt, ladies and gentlemen? Well, like I just said, it's the Big Short all over again. You can start buying that debt now versus waiting around for a deal that's going to come out and get bid on and compete against everybody else out there. I see a lot of investors, oh, it's short sale time. Oh, it's foreclosure time. I'm like, it's debt time because I'm going to beat you to those deals 6 to 12 months out. You can purchase the debt at significant discounts depending on the location, the foreclosure time frame, the values, the condition, what's going on with that asset. You buy that debt and then control the asset for huge discounts. And we're talking huge discounts, 30 to 70% off of where the current market values are at. The strategies, variety of strategies, loan reinstatement, modification, short sale. Hey, you've been behind for 6 months. Let's just put the 6 months on the face amount of the loan. Can you start paying again? Can you start paying half and working your way through that stuff? Not only can you do that in the residential, but you can also do that in the commercial side. Take over the note if you want to and turn it into cash flow with performing note or reperforming, or take over the property, let the borrower walk and do what you want with it. Reposition, repivot the asset like we talk about. There's a variety of different strategies that you can do. Now, some other advantages of note investing that I like to. Many investors are out there are dropping thousands and thousands of dollars in direct mail trying to find a deal. We don't do that in the note game. We don't drop thousands of dollars on marketing and postcards and yellow letters and bandit signs. We don't do that. We don't do that at all. We're contacting the banks directly. We're not spending a single dollar on direct mail to find deals, ladies and gentlemen. If you can send some emails, if you can jump on LinkedIn or you can pick up the phone and dial for dollars, you can do this business just a few hours a week if you want to. There's plenty of banks out there that have assets on their books. And if you reach out to them, not only going to just send you one, like most postcards, letters, you're going to find one deal and have to rinse and repeat it all over again. With banks, hello, they have stuff every month, every quarter that can be a rinse and repeat cycle of them sending you deals to cherry pick from. And you don't have to buy the whole thing. You don't need to have $5 million to do this. You can cherry pick the best deals, single family homes, commercial loans, as long as you guys can come to some sort of price point. Great, you can cherry pick the best. Now, if you can buy in bulk, guess what? You're gonna get better pricing on assets. And you can do this with residential and commercial assets from banks all across the country, all right? And you know what, ladies and gentlemen, you can also, if you don't have your own money, go out and raise capital from other investors to fund purchase. There's plenty of investors out there that have money. People have more savings now than they've ever had before. A lot of money sitting on the sidelines wanting to do something with, okay? Now, guys and gals, the banks are bracing for 15 million defaults now. In our peak in 2010, that's what we saw was 15 million 10 years ago. Do I think we'll get to that number? I don't know. I know we're going to get to 10 million at least, because we're probably already close to 8 right now, and nobody's talking about that. So the biggest question I have for you is, how much of that do you want to be? And you don't have to buy a quarter of the pie. Trust me, Wall Street and a lot of the government agencies are going to drag things out. There are going to be some big buyers, but there's still plenty of stuff, plenty of crumbs to make some good money, all right? Now, are there real estate investors out there, people to fund your deals? Heck yeah, there is. There's over $9 trillion in retirement funds sitting out there basically on the sidelines, and a lot more of it right now with more people being laid off and things like that. Now, looking just at Orlando, just in Orlando, there's 21,000 investors that have an IRA account, an individual retirement account in Orlando, okay? In the Orlando area, 21,000 investors. Out of that amount, 14,000 of them have at least 150 grand or more in their accounts. What? Yes. What? 14,000 have at least 150 grand or more in their retirement accounts. How many people do you need to talk to that list to raise $1 million? How many people do you need to say yes to go out and do something? One person, 2, 3, 4, who knows? Not many, because there's a lot of opportunity right now. Now, if you're, oh, Scott, I don't want to fund with other people's money. I just want to flip deals. Okay, great. Orlando is a very investor-rich market for people looking for real estate deals. You have 20,000, not 21,000, 20,000 people that call themselves real estate investors in the Orlando area as well. That's right. They claim on their taxes they're real estate investors. So guess what? Go find the deals from the banks. If you don't want to raise the capital, flip it to other local investors out there to make money and flipping deals and being an engineer. And the question I'm going to ask you guys is, do you want to be the banker or the borrower? Unfortunately, most of us that are watching this or out there, most people you know are on the borrower side. They're paying money out on a monthly basis, not taking money in. And you know what, ladies and gentlemen, the banks are going to get richer because of a couple of things, because there's a record amount of cash sitting on the sidelines in banks making nothing, making 1% or less. And the banks, you know what they're doing with that? The bank's going out and leveraging that out, giving people 3% loans, 6%, 12%, 20% credit card loans. They're arbitraging your funds to go make something happen. That's why the banks are the biggest. That's why the banks get bailed out, which is ridiculous. They can bail out themselves for the most part if we let them do that. But here's the opportunity. You have the opportunity to go be the bank. You have the opportunity to go buy this debt, utilizing other people's money to leverage it, to give them an above average return what they're getting, and go out and really do something. Because, ladies and gentlemen, the bank always wins out there. We know this. The bank's either going to take the property back or they're going to get the person to borrow. It's just a matter of can they hold out long enough, and they're looking for investors like you and me to step in and buy some of this bad stuff off their books. Local investors or people who understand the local market who can be more flexible. If you bought a loan at 50 cents of what was owed and the borrower wants to stay in their house, a lot of times you can get it reperforming into things. So how do you tap in the tsunami of debt, ladies and gentlemen? I've been working with investors and teaching investors about buying distressed debt since 2010. For over a decade now, I'm called the note guy. I'm one of the guys that focuses on this niche of distressed debt investing. And I'm telling you, it's going to be 2008, 9, and 10 all over again. And if you're not in the distressed note space for the next 12 or 24 months, you're going to look back and kick yourself. Okay? I've helped thousands of investors buy their first non-performing note, their first reperforming note, their first note on residential or commercial properties. I've done it for the last 10 years, and I continue to do it. I am expecting to be busier than I've been in a long time for the next 6, 12, and 24 months. By that time, when the foreclosure REO chain starts to hit, that's when I think people are going to start overpaying for assets. I can beat people 6 to 12 months of the punch for a lot cheaper. Whether you're looking for cash flow or asset growth, this is an opportunity for you. You can buy one-offs, cherry pick the list, or buy in bulk. The banks will be happy to sell you in bulk. Okay, trades from 25,000 up to 5 million or greater. We've done it. You don't need to have $5 million. If you got 100 grand, 200 grand, if your friends, you can raise $200,000, $300,000, $400,000. Guess what? You can buy a portfolio of loans. You can buy a lot of stuff and really make some great things happen out there. And the bank does not care what your credit score is. They're selling you the debt. They're not financing this to you, okay? You don't need to use your own funds. There are plenty of other investors in Orlando or across the country that would be glad to fund your deals if you find something that makes sense to them, okay? And like I said before, if you're coachable and know how to jump on the phone or can follow a script on email or on LinkedIn or on the phone, you can tap into the tsunami unlike others out there that are doing it. So whatever your focus is, as I've said before, whether it's single family homes, apartments, hotels, retail, office space has all been hit hard, self-storage facilities, mobile home parks, whatever it is, ladies and gentlemen, there are deals in all asset classes for you. Okay, you can really create win-win stories, not only for yourself, but for the borrowers that are living in the house. People have lived in the house for 2 years, 5 years, 10 years, 20 years in some cases. We've helped people out. It's not their fault that they got laid off or that the entire economy shut down. We have created a 24-month problem, more of a 24-month issue off of a 90-day problem. And it's been just absolutely, I think we'll all agree, it's been a cluster by all parties on what's happened out there. Florida's been hit hard too with some indecision being made across the board. Maybe you want to buy some nicer looking assets than your single family little homes. Great. Plenty of those taking place out there. Maybe you're wanting to upgrade into multifamily or get into that. I'll tell you right now, multifamily is still one of the most overpriced, but the biggest segment that's going to be opportunistic for investors like you and me is that sub 100 unit, sub 50 unit apartment complex in areas like Orlando, where most of the people living in them have been struck by being laid off or other things like that. Because affordable housing is a big need in Orlando, like it is in a lot of other places, but it's a lot of opportunities for investors like you and me to come in and do a lot of good. And I don't care if you want to do it big or do it small, there are opportunities. Most of our investors start off small, just like Gene did. We met Gene living in Indiana. Elkhart, Indiana is on the north side of Indiana. He was buying assets with his money, properties, fixing and flipping them with what he had. He was very scared to go out and raise private capital because he'd been snake bit before. We met him, taught him about the note business. Fast forward a few years later now, I get a text message from him that he's closed on his 135th asset. He's got over $13 million in private capital raised and invested in his deals. He even started his own fund. And he's out there giving a whole different definition of what retirement is for him. Laura Blunt used to live in Wimberley, Texas, just south of Austin here. We met her. She was like many real estate investors, going to a local real estate club, trying to make something happen, trying to solve some issues in the crazy of the market out there. She found out about the note business, took our training, boom, in her first 15 months, she bought, I think, 14 assets. Most of that with other people's money. Fast forward now, she's closed on over 100 deals. She's getting ready to close on a portfolio of 150 performing notes at roughly 50 cents on the dollar with a $4 million trade with other people's money. Couldn't be more proud of what she's done. She just left Texas, moved to Maryland and moved into her dream home on the water in Maryland. Good kudos to her. We're proud of her. We got Keith Collins. Keith has been around real estate for years. A lot of experience in real estate, fix, flip, rentals, landlording, all that good stuff. Worked for city government. He built water treatment plants and development. But didn't really do much in the note business. Learned the note business from us a few years back. And 2019 was a bumper year. Him and his wife made 7 figures in 2019, and they're expecting to do the same as they keep rocking and rolling. So we're really proud of them. All of these, are great. They're a little older. Nothing wrong with that. A little more seasoned. All right, got some experience, but you don't have to have real estate experience, just like Rafael. Rafael's out of San Diego, a very expensive market. His business has been hit hard as well. He's an entrepreneur, owned a car detailing business, had to lay off all of his entire staff. He would have been a really tough spot there because nobody wants to get their car detailed when they're not driving anywhere, right? But he learned a note business in November. Within his first 60 days, he bought 5 assets. 2 he got reperforming at a 20% cash and cash return. The other 2 he's flipping, doubling his money in roughly 6 months. And then the 5th one he's still working out. And for Rafael, like he says, he's I'm so glad I found the note business. I don't need to have the business reopened. I don't need to be an adult babysitter and get rock and rolling and looking forward to what the future holds for him. Guys, like I said, you don't need to have experience. You don't need to have millions of dollars to go do this. We can show you the way to tap into this, like we have for so many investors across the country who have bought debt, bought a ton of deals, not only for their own portfolio, but working with so many others to really create win-win scenarios, not only for themselves, their investors, but the borrowers on the loans as well. And how do you do that, ladies and gentlemen? Well, the first step, really for most people, is attend our one-day workshop. It's called Note Weekend. It's a one-day online workshop that we teach once a month, usually about the 3rd Saturday of the month. We just taught one this last weekend. Our next one is just a few weeks out. Literally, it's a mini workshop. You're not going to learn everything about the note business in a day, but you're sure to learn a lot. As people will say, oh my gosh, Scott, it's like drinking out of a fire hydrant from Scott Carson from 9 a.m. to roughly 6 p.m. at night. We take a few breaks here and there, but it's not a pitch fest. There's not other speakers. It's yours truly coming in and spending the day with it. Our students call it the Cliff Notes version of note investing. You remember those yellow books in college that you would read instead of reading the full book? Hey, I'll take that all day long. All right, it's live streaming on Saturday. We usually start about 9 a.m. Central Standard Time. Well, I say wrap about 5 or 6. Normal price is $99 per person for be a part of this. Our next round, like I said, we have a class in September. We also have a class in October. We'll probably have one in November and December. All right, it's a one-day class. And $99, hey, affordable for everybody out there. Now you ask, what did we cover at Note Weekend? Well, we cover a variety of topics. The first part of the day, we talk about how and where to find the notes. I'll show you, hey, what to say, what don't you say, who has deals, how to find banks that have deals. We'll give you a list, that Bauer financial list. We'll talk about that in a second here, but we'll show you how and where to find us in the first part of the day. Second part of the day, we'll show you how to raise capital, how to find investors with OPM to fund your deals. We'll get into the different exit strategies and how to make money. I call these 3 things the 3 Fs, how to find, fund, and flip. All right, those big 3 things you need to know about buying distressed debt. And we'll also dive into the big thing that, here's guys and gals to realize, you don't have to be a jack of all trades. Note investing actually is a niche of real estate investing that you rely on other teams and vendors to make things happen. That can help you evaluate deals, pull your due diligence, close deals, foreclose. You don't have to fly out and knock on the doors yourself. You shouldn't be doing that anyway. But we'll talk. We've got over 10 hours of additional training for you guys to watch on the vendors and the different team members that you'll need and want to work with in your note business. We'll also talk about the different trading platforms, residential and commercial loans, that you start looking at deals today, start making offers, looking at, hey, what makes sense here, start breaking down deals, doing some due diligence. And we'll also talk about a lot more throughout the day. We'll talk about some on marketing. We'll talk a little bit on asset protection. We'll talk about some of the things you need to do and don't need to do. We'll give you a sample email to show that we send out to asset managers. We'll give you a short checklist for you to tap into. Literally a 34-page manual that comes along with this for you guys to tap into, and some great things. So I would love for you to sign up for this at noteweekend.com. Very simple, noteweekend.com. They'll get you signed up for what we cover. Now, if that's not enough, one day with all that stuff for $99, let's make it a little bit better for you. We're going to throw in over $1,200 in bonuses for you. Like I said, the one-day Note Weekend training, okay, $99. One day of calling banks training. This is where you get to be a fly on the wall for 4 to 5 hours and watch yours truly literally call the banks. And the beautiful thing, ladies and gentlemen, we have our next one. We do this about once every month, every other month. Our next one is actually tomorrow from noon to 5. If you can't make it, don't worry. It's recorded. This is one of the most enjoyable things that we do. I'll make a list of 100 banks, and in 4 to 5 hours, I'll knock that list out. You'll hear what I'm saying. You'll hear the conversations. You'll see who I'm talking to. You'll be able to ask questions via Zoom on what's going on. That's usually $49. We throw that in as well for you guys, whether it's the live or the replay. Okay. We'll throw on the most recent Bauer Financial list. This is a, like I said, quarterly list that comes out from Bauer Financial. Can run you anywhere from $300 to $500. We'll just say $400, the average cost what we spend. 1,500 plus banks with their rankings, what they have in default on a percentage of their residential, their commercial, multifamily loans. You can see exactly what they've got hurting their books. And it's it's worth signing up just for that list alone. You get a 30-minute phone call with me after the class to sit down and discuss, okay, what's going on? Which way do I want to go? What direction is next for me? I charge $1,000 an hour in consulting. And so that's a $500 value. Glad to talk with you and help you on your path to the next step. Okay. $97. Hey, that's what it costs if you want to buy the replays at most places or have your spouse join. Guess what? We throw both of those in included. And then we've got a great Facebook group, over 900 members strong. Great place for you to ask questions, to network, to ask for people across the country to look at your assets, to ask for vendor recommendations. Great group that we've worked hard to put together over the last few years. That number is always constantly changing as people are coming and going, but that's included as well for you. Like I said, bonuses of over $1,200, guys and gals. I'm gonna make you one thing better here. If you're going through this class and at the end of the day, you're like, Scott, I don't think this is for me. I don't want to do this. I think it's too much work. I'd rather not do this. I'll gladly refund your money back. No questions asked. I don't want to work with people that I don't want to take somebody's money to that's not going to do this. All right. So not only will I refund your money back, I'll make it one thing better for you. I'm going to cut the price in half for y'all. That's right. You can get all these bonuses, $1,200 in bonuses, the replays, the manual, 10 plus hours of training to go on top of our 9 to 10 hours of training on Saturday. All that for just $49. The Bauer financial list, the me calling the banks list. I'm going to show you how to call, who to say, what to say, how to follow up with them, all for $49, ladies and gentlemen. So I would love for you guys, no matter what your goal is, to realize, hey, now's an opportunity. We've got, 4 months till the end of the year. 2020 does not have to suck. For many people, it does. 2021 can't get here soon enough. For me, I'm like, I am about to make as much hay for the next 90 to 120 days that I can to help me accomplish my goal. And like I said, whatever your goal is, we've all set goals at the beginning of the year, whatever it might be. Maybe it is to retire and drinking more frozen drinks. Maybe it is to spend more time with your spouse, to retire your spouse from their job. Maybe it's to pay for your kids' college, whether it's online or in person. Maybe it's to tell your parents, I got you. Maybe it's to actually travel and go somewhere fun on a vacation. Maybe it's just to add more assets to your bottom line or upgrade your house. It all takes money, ladies and gentlemen. And like I said before, the banks don't care what your credit score is. They don't care where the money comes from to fund these deals. You just need somebody to show you how to tap into these deals, how to market them, and how to raise the capital. And that's what I've built a business over the last 12 years doing. I'm the best at what I do in this industry, and nobody else is going to give you more content and care more about what you've got. I've got thousands of videos, a podcast with 600 episodes. I care about your success, and I want you to be one of those 1,000 investors that we can help now and into the future for the next 12 months to tap into this opportunity. So I would love for you guys to get signed up tonight at noteweekend.com. Sign up now. We can get you the links. You can start learning. I can actually send you the replays, the class that we just did, so you can start learning now. And that way when the class rolls around in a couple of weeks, you're even more skilled and more knowledgeable and can ask better questions. So love for you guys to be a part of it at noteweekend.com. Get signed up. I think the next one is September 19th, the class is. It's that Saturday. Get signed up and start learning about the note business now. And if you're watching this live or watching this on the replay, feel free to type in any questions you have in the comment section, and we'll be glad to answer those questions either live now or afterwards in the replay. But thank you guys and gals so much for taking an hour of your time on a Tuesday evening or whenever you're watching this. And hopefully we'll see you at Note Weekend soon. So get signed up, noteweekend.com, and we'll get rocking and rolling for you. Thanks, and be safe, everybody.